Welcome back to the channel, guys. In today's video, we're going to break down everything that's been going on with the whole tariff situation and how it has evolved so far. We'll also dive into why the US dollar is weakening and why gold is soaring to all-time highs. Plus, we'll discuss a few gold stocks that have given a breakout over the past week, even as everything else is diving deep into the red. So there's a lot to cover, but I promise, if you stick around till the end, you'll walk away with a holistic understanding of what's happening. More importantly, you'll be better equipped to make smarter investment decisions. Let's get started. So why did President Trump come up with the idea of imposing tariffs? Why did it all begin? The primary reason was to reduce the US trade deficit. Now, what is a trade deficit? Think of it like this. If your monthly expenses are $5,000 but you earn only $4,000, you're running a $1,000 deficit. The US faces the same issue. We spend more than we earn. So how big is the trade deficit? Well, at the end of 2024, the U.S. trade deficits stood at $918.4 billion, up 17% from $784.9 billion in 2023. As of February 2025, it has ballooned to $1.22 trillion. Just like a family would take loans to cover its deficit, the U.S. Borrows money too. The country's total debt as of December 2024 is $36.2 trillion, and just the interest payment on that debt in 2025 is expected to be around $1 trillion. That means America is not only running a deficit, but is also spending an astronomical amount on interest payments alone. Let's go back to the earlier family example. Imagine a household that earns $4,000 a month, but spends $5,000, so they're already short by $1,000 every month. To cover this shortfall, they borrow money from lenders. Now let's add another layer. Out of the $5,000 they spend each month, assume $2,000 goes just toward paying interest on previous loans, not even repaying the original debt, just the interest. This means that out of the total money they need each month, a huge chunk is just going toward keeping up with the debt. And since their income is only $4,000, they don't have enough to cover both the interest and their living expenses. So what do? They borrow even more money. This cycle keeps repeating. Every month they borrow more to pay old interest and cover new expenses. Eventually it reaches a point where they're buried under so much debt that they can no longer borrow more. Or worse, lenders stop trusting them. That's when default becomes a real risk. Now apply this same logic to the US economy. The country is earning less than it spends. A massive portion of its spending goes just toward interest payments on debt. And unless it cuts spending, it will have to keep borrowing more, leading to a dangerous and unsustainable loop. So, to deal with the problem, President Trump came up with reciprocal tariffs as a solution. The main reasoning behind this was to make imported goods expensive to sell in the US so that people don't buy imported goods as much, lowering the trade deficit in the short term and also encouraging big corporates to start manufacturing locally in the long term, which would help create jobs and also increase exports, further narrowing the trade deficit. So did it work? Well, we will see that in a moment. On 2nd April, on Liberation Day, President Trump announced reciprocal tariffs on 180 nations, and all hell broke loose in the stock market. But President Trump had been talking about tariffs even before he got elected, so shouldn't the market have been prepared? Well, the shock came not from the idea of tariffs itself, but from how the tariffs were calculated. Instead of basing reciprocal tariffs on what other countries were charging the US, the Trump administration used a formula that calculated tariffs based on the trade deficit the US had with each country. This led to inflated tariff percentages, much higher than expected. As a result, countries like Singapore and Australia, which didn't impose heavy tariffs on the US, suddenly faced high US tariffs just because of the way the formula worked. This unexpected move rattled global markets, and the stock market just nosedived from there. Then, around the 4th or 5th of April, while the market was in full-blown panic mode, President Trump posted a video on his Truth Social handle. In that video, he suggested that the fall in the stock market was actually part of his grand plan. His reasoning? A sharp market crash would trigger fear and uncertainty, causing investors to rush toward U.S. government bonds, which are considered safe haven assets. That spike in demand would push bond yields lower. And once yields dropped, the government could refinance portions of its massive debt at lower interest rates, potentially saving billions of dollars in interest payments. But did that actually happen? We'll know in just a moment. Before that, we need to understand what bond yields are. Once you get this concept, you'll be able to connect the dots and build a much deeper understanding of how the financial system operates. To understand bond yields, let's return to our family example. When a family runs a deficit, spending more than it earns, it covers that shortfall by borrowing, whether through credit cards, loans, or help from friends. Similarly, when the US government runs a deficit, it raises money by issuing bonds. So imagine the US goes to global investors and says, we need $1 trillion. You lend us the money by buying our bonds, and in return, we'll pay you a fixed interest rate annually. Once the bond matures, we'll return your full amount. This agreed interest is what we call the bond yield. Now, here's where the US holds a unique advantage. Despite offering low interest rates, say just 2 or 3%, it still attracts massive demand for its bonds. Why? Because investors across the globe trust the US economy, largely because the US dollar is the world's reserve currency. Let's take an example. Suppose Afghanistan offers 5% and the US offers 2% interest rate on their bonds. Whose bond would you buy? Most would go with the US because it's perceived that even in worst-case scenarios, the US literally has the privilege to print dollars, a currency the whole world uses, and repay its debt. Let's take another country, China, for example. They might need to offer a much higher interest rate, say 6%, to attract the same investors who otherwise might flock to the USA, even at just 2%. Because it doesn't have the same level of global trust or a reserve currency to fall back on. So the reserve currency status of the USD is literally a blessing for the USA. In short, the more confidence the world has in your economy, the lower the interest rate you need to offer to raise funds. And the less trust investors have, the higher the yield a country must promise to attract buyers. Bond yield is a mirror that other nations hold to show the true value of an economy in the global market. Now let's go back to that video President Trump shared on Truth Social, where he claimed the stock market collapse was part of a grand plan. The idea was that as panic set into the stock market, investors would rush toward U.S. bonds, considered safe in times of uncertainty. More buyers would mean higher demand, allowing the U.S. government to issue new debt at lower interest rates, refinance existing loans, and potentially save billions in interest payments. That was the plan. But did it work? Well, the answer is shocking. It did not. In fact, the exact opposite happened. Instead of yields dropping, the 10-year U.S. bond yield surged to 4.5%, a move that caught the administration completely off guard. This tells us two things. Either there was a massive sell-off in U.S. bonds, or there simply weren't enough buyers willing to accept low yields. Both possibilities are alarming because they point to declining trust in the U.S. economy among investors, those who've been funding our deficits for decades. And since these bonds are purchased in U.S. dollars, a lack of demand also reduces the demand for dollars. As a result, the U.S. dollar has weakened, not just in isolation, but against strong global currencies like the euro and the Swiss franc. That's a big deal. It signals a potential generational shift in global trust, something we haven't seen before. Now, if the dollar keeps falling, sure, it technically makes U.S. exports cheaper. But the bigger issue, the very foundation of America's financial credibility, is now being questioned. That unexpected spike in bond yields, it forced the Trump administration to slam the brakes on the reciprocal tariffs for nearly every country except China. And even with China, essential products like laptops and smartphones were quietly removed from the tariff list. But here's the part that raises eyebrows. Before the pause was even officially announced, billionaire investor Bill Ackman tweeted that the tariffs should be delayed. So the question is, are these major economic policies based on a well-thought-out strategy? Or are we just watching the government react to market panic in real time, swayed by powerful voices? Now, real quick, why do so many countries run trade surpluses with the US? In simple terms, they sell more to us than we sell to them. President Trump wasn't exactly a fan of that. But one of the biggest reasons behind these trade imbalances is the role of the US dollar as the world's reserve currency. Here's how it works. Countries all over the globe need US dollars, especially if they want to buy US government bonds. But to get those dollars, they have to sell goods to the US. And ironically, that global demand for dollars keeps the dollar strong, which makes American-made goods expensive. Poorer countries feel that pricing pain the most. They can sell us their cheaper goods, but they can't afford to buy ours. Just think about it. How many Harley Davidsons do you expect to see roaring through the streets of Bangladesh? Or how many poor African families can afford an iPhone? It's not about preference. It's just not economically feasible. So these countries sell goods to us, earn dollars, and then use that money to buy US bonds, effectively funding our deficits at low interest rates. And on paper, this shows up as a trade deficit. It might look like we're getting ripped off, but in reality, they're propping up the dollar and helping us raise cheap debt. These trade imbalances aren't just about unfair trade. They're deeply embedded into how the entire global financial system works. And unless the US is ready to give up its reserve currency status, which would trigger massive ripple effects, eliminating the trade deficit completely is almost impossible. So, is there a way to both keep the dollar as the world's reserve currency and shrink the trade deficit? There is, but it won't be popular. In my opinion, the only real path forward is to massively cut spending across the board. That means the federal workforce, defense budgets, welfare programs, everything. We need to start living within our means. It's time to stick to a strict fiscal budget, even if it means lowering our standard of living for a while. Because if we don't, this vicious debt cycle could eventually force the US to default. And trust me, you don't want to be around when that day comes. Our current level of consumption, especially in developed economies, isn't sustainable. Just take smartphones. We get new models every year, but what actually changes? A slightly better camera, a marginally bigger battery, some new software features? These aren't game-changing upgrades. Honestly, phones today are like nail cutters or combs. We've hit a point of innovation saturation. Buying the latest model every single year? It's just unnecessary. Unless there's a radical innovation that genuinely transforms how we use a product, we need to rethink our buying habits. Because this cycle of overconsumption isn't just bad economics, it's unsustainable living. All right, so here's the real question. When the US dollar is weakening and bond yields are rising, where's all the money going? Because let's be clear, money doesn't just sit still, especially in times of uncertainty. It always looks for safety. And while currencies like the euro and the Swiss franc are gaining strength, there's one asset class that's absolutely stealing the spotlight right now: gold. Yep, gold. The age-old safe haven is having its moment. And not just a small move, we're talking a major breakout. In the past few weeks, gold has surged to new all-time highs, completely defying the broader market trend. While most stocks are dropping like a knife, gold stocks are exploding. It's almost like the market is sending a message. When confidence in fiat currencies fades, when trust in government debt erodes, investors don't wait. They rush to what's real, what's proven. And right now, that's gold. All right, so before we jump into the stocks that have broken out the past week, I just want to quickly clarify something. Some of the analogies I view this video might not be technically perfect, but the intention was to simplify a very complex financial situation. So even if you're not deep into economics, you can still get the big picture of what's going on. Also, let's be real, things are moving insanely fast right now. With new announcements and policy changes dropping almost every half hour, I wouldn't be surprised if some of what I've said has already been flipped by the time you're watching this. If that's the case, I apologize. All right, so the first breakout stock from the gold sector this week is Gold Fields Limited, ticker symbol GFI. And this one is truly special because what we're seeing here is a breakout that has happened after nearly 19 years. Yes, you heard that right. Almost 2 decades. I've got the chart pulled up on the monthly time frame, and just take a look. The last time this stock hit a high was back in May 2006 when it touched around $23.20. Fast forward to April 2025, and it has finally broken above that level. This is a monumental breakout, and it just happened in the previous week. The breakout candle looks strong and convincing. It's got a solid body and a good lower wick, indicating strong buying interest. This isn't just a technical fluke. It looks like a genuine shift in momentum. Now, of course, whether or not you enter the trade is entirely up to you. As always, this channel is not about giving investment advice, but simply acting as a screener for stocks that are sitting at crucial technical levels. And here's a cool little fact. We actually covered GFI on this channel back on March 29th. Since then, the stock has rallied about 25%. That's a 25% move in a gold stock in just a couple of weeks, while the broader market has been falling like a knife. If you caught that move, I just want to say congratulations. This is exactly why we track these patterns. GFI is one to watch closely. Goldfields Ltd is a gold mining company involved in the production of gold and the operation of mines. Its active mining operations span across Australia, Ghana, Peru, and South Africa. The company was founded on May 3rd, 1968, and is headquartered in Johannesburg, South Africa. From a fundamentals perspective, Goldfields has generated an income of $1.23 billion on $5.14 billion in sales, reflecting a healthy profit margin of 23.89%. It has a PE ratio of 18.08 and an EPS of 1.36. The company also offers a dividend yield of 2.26%. The second breakout stock from the gold sector this past week is Eldorado Gold Corporation with the ticker symbol EGO. Now, this one has a very similar setup to GFI, where we're seeing a classic horizontal breakout pattern. Let's look at a few key details on the daily time frame. EGO had made a previous high of around $19, and that high was set on October 21st, 2024. It's taken about 6 months for the stock to consolidate and finally break out above that level. As of now, the current market price is $19.34, which means the breakout has just happened and the stock is still within a very tradable range. So keep EGO on your radar. Whether or not you decide to enter a trade, as always, do your own due diligence. This channel is all about spotting key technical levels, not giving investment advice. Eldorado Gold Corp is a mid-cap company with a market cap of $3.97 billion, operating in the basic materials sector. Eldorado Gold engages in the mining, development, and exploration of gold. It operates across 3 main regions: Turkey, Canada, and Greece. The company was founded on April 2nd, 1992 by Richard J. Barclay, Marco Antonio Romero, and Gary D. Norden, and is headquartered in Vancouver, Canada. Eldorado Gold has generated an income of $289.12 million on $1.32 billion in sales, reflecting a strong profit margin of 21.84%. The company has a PE ratio of 13.73 and an EPS of 1.41, but currently does not offer a dividend. So guys, if you have liked the video so far, let me request you to kindly give this video a thumbs up and also comment on the video. If you are a subscriber to the channel, YouTube will show you the video first, and based on your engagement with the video in the form of likes and comments, YouTube will decide whether it wants to push it to new viewers or not. So if you are a subscriber to the channel, I kindly request you to please give this video a like and also comment so that it is pushed to a wider audience. The third breakout stock from the gold sector on our list today is United States Antimony Corporation, trading under the ticker symbol UAMY. Now, this stock follows a very similar breakout structure to the last 2 we discussed. Let's quickly break it down. The chart you're seeing is on a weekly time frame, and it shows a powerful breakout. The previous high for UAMY was around $2.56, and that level was last seen back in February of 2021. So it has taken nearly 4 years to finally break through that resistance zone. As of now, the current market price is $2.79, which confirms that the breakout is in play and gaining momentum. Just like the other 2, keep this stock on your radar. The pattern is strong, the breakout looks clean. United States Antimony Corp is a small cap company with a market cap of $319.82 million, also in the basic materials sector. The company is involved in the extraction, processing, and sale of antimony, zeolite, silver, and gold products. It operates through multiple segments, including U.S. antimony operations, Mexican antimony operations, precious metals recovery, and U.S. zeolite operations. Founded by John C. Lawrence in June 1968, it is headquartered in Thompson Falls, Montana. From a fundamentals view, the company reported a net loss of 1.74 million on sales of 14.94 million, resulting in a negative profit margin of minus 11.63%. It has a negative EPS of minus 0.02 and does not currently offer a dividend. The fourth company on our list today is Alignment Healthcare, trading under the ticker symbol ALHC. This stock has also given us a horizontal breakout, and the chart you're seeing is on a weekly time frame. The previous high was made back in August of 2022 at a price of $19.17. After consolidating for nearly 2.5 years, we finally saw a breakout last week, with the stock now trading at around $19.74. So that's another stock to add to your watch list and track its momentum in the coming weeks. Alignment Healthcare Inc. is a mid-cap company with a market cap of $3.79 billion, part of the healthcare sector. This holding company operates a consumer-centric platform providing customized healthcare solutions primarily for seniors and chronically ill individuals via its Medicare Advantage plans. Services are offered through its Alignment Health Plan, as well as through partnerships with select health insurers. The company was founded in 2013 by John E. Kao and is headquartered in Orange, California. Financially, Alignment Healthcare reported a net loss of 128.03 million on sales of 2.7 billion, indicating a profit margin of minus 4.74%. The company has a negative EPS of minus 0.67 and does not pay a dividend. I often get comments from viewers asking how I screen the stocks I discuss. Unfortunately, I don't have a public portal or website to share because I don't rely on one. Coming from a software engineering background, I've built my own custom algorithms to scan the market for various setups. Stocks breaking out of a horizontal range, stocks breaking out of a downtrend, stocks at support while in an uptrend, stocks nearing a breakout, both horizontal and downtrend, stocks that have broken out and are now pulling back for a retest. I run these algorithms on historical data for around 3,500 tickers, then manually analyze the shortlisted stocks. If I find a promising setup, I share it in my videos. So if you want regular updates on stocks at crucial levels, I'd highly recommend subscribing to the channel. That's it for today. Hope you found this useful, and I'll see you in the next one. Have a great weekend.